You know how you always see headlines that are like, the stock market is about to crash? Well, in this video, I'm going to cover why there are so many headlines about that and what you should do about it. If you've never seen my face before, welcome to the Dana Yee Show. My name is Dana, and on this channel, I cover everything about money and finance. If you enjoy this video, make sure to bop that like button and subscribe for more awesome content like this. As always, I'm not a financial professional, so don't make any investing decisions based on what I say. I'm just here to essentially gather my thoughts and opinions based on what I read and opinions that I make based on what I read from the internet. So here are just some examples of these doomsday type headlines that I see all around. Will the stock market crash soon? And this was posted shortly after there was quite a bit of a correction in the stock market, right? The stock markets have experienced another brutal week. Inflation fear, soaring bond yields, blah 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 blah. The fear is that we could see even more intense sell-off that could crash the stock market. In this CNBC article, Tesla suffers its biggest fall since September 2020. I think it went from $900 a share to almost below $500 a share at one point, so almost having its value. And if you just look up stock market crash on YouTube, for example, you see videos like, the markets are in a danger zone. Is ARK's Cathie Wood in the face of a market bubble? The stock market crash of 2021. I sold all my stocks. The stock market crash of 2021, and just countless videos and headlines like this. Before I cover why I think there are so many of these types of articles, I want to define what a market crash actually is. Generally, it's defined as a sudden and very sharp drop in stock prices, and a lot of places define this as a prolonged decline of 20% or more in the market. So for example, in 1929, the stock market fell basically in half in less than 2 months, and in 1987, stocks plunged 23% in a single day. A prolonged crash can lead to what is called a bear market, so it's essentially a long sustained decline in the stock market, and this can lead to things like recessions, and people are always scared that we're just on the precipice of going into a bear market. On the more tame end, a stock market correction is a more tame sort of drop between 20 but less than 20% of the recent stock market highs, and going even smaller than that, a market dip is any brief downturn. If you'll note, the market is kind of like a kangaroo. Sometimes it's up 4%, down 2%, up 3%, down 5%. Just like these little dips and rises can be considered much less significant than a crash, obviously. So onto the reasons why I think there are so many articles like this is essentially that they do very well and they're very clickbaity. As humans, we have something called negativity bias, where essentially we notice negative things more and they impact us more. When we see negative headlines, we're like, oh my god, why is the news negative? I need to read this and find out. Should I do anything differently? Like, what's going on? And because of this, we are drawn to it. And when people click articles, that generates more revenue for whoever's putting out the articles, which makes them make more negative articles, which makes people click them more. And it's this negative sort of feedback loop. And another thing to note is that good sort of headlines usually don't do as well. Like if you see the article title, John Doe is fine and dandy for the 3,000th consecutive day and nothing is new, no one's gonna click on that. But if you see the stock market fell 10% in a week, is this the beginning of a crash? You're probably gonna click on that and see, why is this happening? Should I be worried? Should I start selling my shares? Another explanation for this is something called the prospect theory in psychology, which really applies to behavioral economics well. It combines the concepts of loss aversion and risk aversion, where generally humans are less willing to take risks even if the outcome could be much better, and people are very averse to loss, so they would be willing to lose a little bit now then potentially lose a lot more in the future. And this also sort of has the conclusion that people feel the pain of losses more than they reap the rewards of winning. If we split this into risks associated with gains and losses, in the case where people have a risky choice that leads to gains, they're usually risk averse, so they prefer solutions that lead to lower expected utility but with higher certainty. An example of this would be, let's say we play a game and I say you can either get $1,000 with 100% certainty or $3,000 with 50% certainty. If you look at this from a purely objective standpoint, the expected value of the second option is better, but a lot of people would choose the first one for the guarantee of some sort of profit rather than the chance that they could not get anything. On the other hand, when people are faced with a potential risk for loss, they are risk seeking, so they prefer solutions that lead to lower expected utility as long as it has the potential to avoid losses. This manifests in the stock market, so for example, if this is some stock stock. You buy it here, it's moving around, generally trending upward. And then one day it does this. Some people see this and say, oh my god, it's going to zero before it comes back up again. I'm gonna sell now to make sure I don't lose more later. Or I'm gonna sell now so I can buy back later at the bottom. And the reason generally that they want to sell is that they want to avoid more loss. Another flaw with that sort of thinking is if they think they'll just buy back later at the bottom is very hard, if not near impossible to time. And if it gets past the bottom, so if the stock continues to move, they might think, oh my god, it was there at one point, it's gonna crash again, I'll just buy it when it crashes again. And then it ends up never crashing again. So it's really hard to time the market is essentially what I'm saying. And a real example of timing the market poorly, I guess, would be the most recent example, the 2020 crash. If we look, the market lost about 30% of its value in just the course of a month, and a lot of people sold on the way down, or they sold at the bottom with the mentality that when it goes lower, I'll just buy back, so that they don't experience these big losses now. However, if they had waited for the bottom, it never came, it didn't bottom again. It's been up, 50% since then. Out on a slightly longer time frame with the financial crisis around 2008, the stock market fell almost half in the course of about 3 months. If people sold on the way down with the intention that they were going to buy back later at the bottom, they would have missed out on this really long bull run where the market more than doubled in value. And just to sort of reiterate that again, people feel the pain of losses more than the joy they get from a gain. Another reason I think you see a lot of headlines like these, especially from experts in the investing industry, so potentially hedge fund managers or just generally large investors, is if they say it enough, eventually they'll be right. And then with that one time that they're right, they can be praised, they can get a book written about them, they can make a movie about it. One example of this would be Michael Burry and The Big Short. This, I think, was a slightly different scenario because it wasn't just based on, oh, the market's too high, it's gonna drop soon. It was based on a lot of research that he did and essentially uncovering the issues with the housing market at the time. So that was a little bit different, but one sort of example of this in modern times would be Jim Chanos, I don't know how to say his last name, has been shorting Tesla for a really long time, and he did have some valid concerns, essentially saying things like Tesla is only 1/2 of new car sales, or in 2020, they're not actually making any money selling cars because Tesla, as an electric vehicle company, gets credits from the government for selling electric vehicles. However, as we all know, Tesla had quite the run in 2020, up 700%, and then that made its market cap over $500 billion. So if he had been shorting this the entire time, he would be feeling quite the pain right now. And he says it's been painful, clearly. And just sort of on a broader example, if every year you say the market is going to crash, yeah, at some point in the future, the market's going to crash. There are going to be corrections, there are going to be pullbacks, there are going to be really long bull runs. But if you say it enough, you'll get a lot of clicks and you'll eventually be right, and then you can say, hey look, I was a genius, I called it. Just ignore the other articles where we had the longest bull run in history. So the reasons I think so many of these headlines come up are that negative headlines get more interaction, they're more clickbaity, people are risk and loss averse, so they feel the pain of losses a lot, and if experts say it enough, they will eventually be right, and then they can be praised and say, oh my god, I was so smart. From a non-financial professional, I think there are a few things to keep in mind and a few good things to do. One is to ignore the noise. Especially in the age of social media and everyone being inside and on the internet pretty much all the time, there's going to be so many articles saying good things, saying bad things, saying the market's about to crash, saying we're in a stock bubble, saying we're in an EV bubble, saying pretty much anything on the internet. And it's really hard to ignore the noise, but there's so many news outlets out there, there's so many articles being published, and try not to sort of panic yourself by seeing all of these like, the market's gonna crash type of articles. Secondly, one of the best ways to instill confidence in your own investing skills is to do your own research. This is kind of a vague phrase, and I actually plan on making a video in the future of what it means to do your due diligence or do your own research. I feel like I say this in a lot of videos, but you should be investing in companies that you like, that you see a very bright future for, and that you essentially, if it fell down 30%, instead of selling, you will want to buy more because then it will be 30% cheaper than you bought it for. And also, kind of side note, stocks are like the only thing that people like to buy when they're really high and sell when they're really cheap. It's weird, right? Okay, thirdly, one of the best ways to combat any downturns in the market is to invest consistently. That way, if the market's going up, you invest. If the market's going down, you invest. And this is essentially averaging up or averaging down. And I like to believe that in the very long term, 20, 40, 100 years from now, the stock market is going to be trading at a much higher value than what it's currently trading at, because I like to believe that the American economy is going to grow and the value of companies are going to grow, etc. And I think if the entire market went to zero, we would have much bigger concerns than our portfolios. Fourthly, one thing to keep in mind is that the market tends to bounce back. If we again go back to the SPY example, in the dot-com bubble, in the grand scheme of things, this 40% drop almost looks like a flat line in the all-time chart. And similarly, in the 50% drop or so in the housing crisis, it's sort of a blip on the graph over the long term. And if we go to the 5-year chart, yeah, the 2020 crash was really big, but we have since recovered and surpassed that. And if we look at the maximum chart, the 2020 crash is kind of just a blip on the graph. So the market does tend to bounce back. Now, I don't want to continually say these things that you should do in the market and then not follow it myself. So I want to give one example of how I'm following this advice of consistently investing and ignoring the noise. I essentially have a list of stocks that I want to own eventually or want to add more money into, and one of them is Square, which is a really awesome fintech company that does payment processing. I'd been meaning to buy it for a while, and when I saw that the stock price dropped 30%, I was like, oh my god, this is a fantastic deal. And if you actually look at the date, I did happen to buy on the very bottom. I was not trying to time that. I just saw it at such a discount, I couldn't pass up an opportunity to buy it. And if you look, I took this screenshot earlier in the day. I was up about 11.5% since buying it. I think it's 12 or 13% now, which is kind of ridiculous. And on such a small position, again, I do want to buy more, but this is just one example of how I'm consistently investing and taking opportunities like 30% discounts in the market. So that was my little recap of what I think you should do and what I've been doing in the markets. If you want to see more of my portfolio, make sure to comment down below and subscribe. And again, thank you guys for watching, and I'll see you guys soon.